Hello leaders, this is Jason Graziani. Welcome to our channel, Leader for Life. Today we're going to continue on with our financial series, and we're now on part 4, which is types of life insurance. As you recall in our last video, video 3, we talked about the X curve. And the X curve really gave a bigger picture about what it is that we do financially here and your first step, which is setting up your insurance for your future. And this could be a kind of a area where people don't really know what to do next and really like, how do I make a decision? Where do I go for insurance? How do I do it? And I want you to know something. I really have 3 disclosures as I kind of explain the material that's behind me here today. Number 1 is suitability. I'm not recommending any of these types of programs and policies to you because I don't know your specific financial situation. I am licensed in this industry, but there are no recommendations here today. Number 2 is compliance. If you're going to speak to anybody about life insurance policies, you want to talk to a licensed agent. And you could look all of us up. I'm one of them, and there are many in the country. You could look us up on the State Department of Insurance and make sure that we're properly licensed to be able to talk about this material with you. And the 3rd disclosure is really, why are we even having this video to begin with? It's to empower you. It's to empower you to make choices that are best for you. Don't take my word for it. Don't take somebody else's word for it. I want to empower you to make a decision that's best for you. Final disclosures over here. Potential, not guaranteed, no legal or tax advice. I am not an attorney, nor am I a tax professional. I do not hold myself out to be a professional in any tax or legal matters. However, we will talk generally about some of these subjects to make sure that you're empowered to make a best decision. So let's go ahead and jump into part number 1. Okay. Top left, term insurance. If we were to break down insurance, life insurance specifically, we would say that there's term and perm. Perm stands for permanent, but term and permanent. Under the permanent umbrella, we're going to cover 3 different types here today. So let's start off with term, which is the simplest to use, the most commonly known, and has the longest history of being used here in the United States, which is term insurance. Now, term insurance, positives to understand. It's the cheapest. It's the least expensive insurance. So if cost and affordability is an issue for you, you may be looking at term policy. Also, think of it like renting an apartment or renting a house versus buying a house. For some people that say, well, term isn't very good. Well, just let me ask you a question. Did you ever rent a car? Did you ever rent an apartment? Have you ever rented something? At that time that renting was more appealing to you than buying, that's kind of the same when insurance would be used term specifically. Now, con, it's not permanent. It will expire. Also, there's no cash value. And so the reason it's the least amount of insurance is because it will expire. And so in this diagram right here, if this was your age, at whatever level you started your policy, term will probably cover you for a period of 10 years, 20 years, maybe 30 years, most common. But at the end of that period of time, it expires. You could also see return of premium or ROP term, which is essentially where you could pay about twice your premium, but you get all your money back in the end. See your agent and ask questions about that if that's something that could be a fit for you. Let's look at part number 2, whole life. Whole life really came around, and the reason whole life was popular was because people wanted coverage for their whole life. Similar to the way Social Security came out originally, where they put the age of retirement at 65, but the percentage of people that lived and worked well past 65 was very low. Well, now with modern medicine, longer life expectancies, people are living longer. And so what was happening is people are outliving their term. So they got whole life. And the benefit of a whole life policy is that it's permanent. It'll cover you till you're at least 100 years old. Typically, whole life will cover you until you're 100 years old. There's a guaranteed premium, meaning no matter what happens in the future, you're going to pay the same amount of money on a monthly basis. It's never going to change, and you have that guaranteed premium for life that will give you guaranteed coverage for life. Finally, this cash value accumulation portion, this green shaded area that you see right here, it's safe. So you could see returns from anywhere 3, 4, 5%. I'm not quoting any types of returns. There's many different companies and dividend options out there, but just generally speaking, it's a safe place to accumulate your cash value. What's the con? It's more expensive than term because it's permanent, meaning you have to contribute to this cash value element as well as the insurance element, and I'll address the diagram here in just a moment. Initially, it's a low surrender period. Don't get too confused when I say surrender period. It just means this. If you start putting in a monthly premium and you think you're going to be able to pull cash out within a few years in the short term, most likely, and again, you have to go see your own agent and your own company and policy, most likely you don't have access to that cash value early on. So this is a long-term account to where you could pull money out if you do and do it properly, but you have a low surrender, meaning you can't touch very much money early on. Less flexibility, meaning you can't change your monthly premium. You really are kind of set to the contract terms and you kind of follow those contract terms. You don't have a lot of flexibility and options. And then finally, dividends are not guaranteed. Many times an agent that's selling the whole life policy may quote different dividend returns, but we have no guarantees about what the dividends are going to do. And so if you look at the way a whole life policy works, what I want to draw your attention to is here's $1 million of insurance, here's your age. As you start contributing your premium on a monthly basis, your cash value begins to grow. God forbid if something was to happen to you, say in the middle of this diagram here, you will get this much money or your cash value back, shaded in the green, and then you will get that much of the insurance company's money back to give you your $1 million. Most likely you would live a longer life, and upon passing away, you would get most of your own cash value back and a little bit of the insurance company's money, which leads us to the part 3, the next type of policy, which is, wait a minute, I'm putting in money all the time in my cash value, but when I pass away, I'm kind of just getting my own money back that the insurance company's been holding the entire time of my life. Yes. Now, whole life is still a good policy if you need permanent life insurance. But if you're looking for cash value accumulation, you may want to look at a couple other different options. As I transition to the next point, see also final expense. That's another type of whole life policy that's going to be a little bit more limited, but for specific cases. So final expense, kind of put it in this family, the whole life family. But let's shift your attention over here to point number 3, which is universal life. Universal life, or UL, as it's most commonly understood by, essentially took the concept of whole life where you have both insurance and cash value. And then what it did is it separated the two. But it put it into one umbrella, okay? We call these like the circles. And you have your insurance, which is a cost, and then you have your cash value, which is your asset. And so essentially the way this policy is structured, this money sign right here is your monthly premium going in to your cash value. Your cash value has a little valve on a monthly basis that pulls out the cost so that whatever amount of life insurance you have, that'll determine the cost of your policy. The way the insurance company makes money is they pull out the cost to pay for the insurance from the cash value that you contributed. Now, what's the benefit of having a UL versus maybe something like a whole life policy? Flexible premium. You could control how much money you're putting into the account, so you could put in a lot one time, and then maybe you come up to some times where you really can't make a contribution, and so you could kind of pull back and maybe not even make a contribution, but your policy doesn't cancel because the insurance can be covered by your cash value that you have right here. Changing your death benefit, you could change some of your options and have just a little bit more flexibility so that as your needs change over the course of your life, you could change the policy design, so it gives you a little bit more flexibility overall. What are the downside? There's no guaranteed cash value. So although that it's similar to the way a whole life works where you have an incremental interest rate, maybe a few percentage points, but there's no guaranteed long-term cash value, it is more expensive than a term policy. So you have to put, just like a whole life, you have to put the cash value component there too. And also initial low surrender, which we covered on the whole life side. And so you could see also GUL, guaranteed universal life. Essentially, if you do want a guaranteed cash value amount, or if you want a guaranteed death benefit for your family in the future, let the agent know that you're sitting down with, say, hey, listen, I want more of my premium going to death benefit. That's more important to me. Or I want more of my premium going towards life insurance or cash value accumulation. That's more important to me. Let the agent know, because us agents, we tend to think of everything like a Swiss Army knife, like it could do everything for you. But if you're really going to set your plan up perfectly for you, and of course you're the judge of that, you want to make sure that you tell the agent what are the variables that are most important to you. Is it death benefit, living benefit, or the cash value accumulation? Which is most important to you? Which leads me to the last one, the IUL, the Indexed Universal Life. So you see indexed UL or IUL. Now, what's the benefit, okay? Before I get into pros and cons, the index UL, as you see this diagram right here, imagine the UL with the circles. And imagine this little chart, which again, this is a hypothetical drawing. Now, past performance is not indicative of future returns. I cannot predict future results in the stock market. And I'm giving you a facetious face right now, but I'm giving you a disclosure that this is a drawing. It's not actual returns. It's just a hypothetical. So in this drawing, what it's meant to do is imagine this green circle right here. How does the interest work, Jason? Take a look at 3 different ways. This flat line here that has incremental growth is a fixed account. You could select to have a fixed 1, 2, 3%, whatever an insurance company is offering at that time. This red line right here, this would be a variable product. Now, in order for an agent to talk about variable products or to get into variable, they have to be securities licensed in order to do so. But variable just means that you have the opportunity for growth and you have the opportunity for loss as it's tied directly to stock market. This dotted line that you find in here is really where the term indexing comes from. And so here's the trade-off. What is indexing? Not to be confused with an index fund, which is a noun, which is essentially just another type of mutual fund you put money into. Indexing as a verb, meaning what does an insurance company do with my money? Here's the trade-off. Imagine the insurance company came up to you and said, hey, what if we gave you half of your gains, but we kept all of your loss? In other words, you have no risk, but we're gonna absorb the risk for you. And the cost to you is we're gonna keep a percentage of your gains. That's essentially how indexing works. So a consumer may not like Six Flags roller coaster returns. A consumer may like Disneyland, maybe some teacups, meaning the market the account's never really going to skyrocket upwards, but you're not going to lose. That you have a guarantee on your account, so you have the opportunity for some growth, and it's right here in the pro. Safe way to earn potential gains. Safe way to earn potential gains. There's no guarantees for gains, but it's a safe way to earn potential gains. Income tax-free distributions. If you set it up correctly, and if you keep your policy open, you can access your cash value and create an income stream for yourself that could be income tax-free. Again, I am not an attorney. I am not a tax advisor. Go see an attorney or a tax advisor if you're going to implement this into your strategy. But the cons, similar to the rest of the permanent policies, it's more expensive. There's no guarantees of a high rate of return, so don't let an agent tell you that's correct. And you have an initial low surrender. Now, as you look at these 4 options, I hope you think for yourself, what is best for you? Are you in a situation where you're trying to maximize your insurance, but you have really limited means or you can't afford a higher premium, and maybe you need to look at a term policy, which many term policies are convertible to permanent policies later if you applied and if you would get approved for a plan like that? Or are you looking more for something that's just permanent life insurance and I don't need cash value accumulation, I just want a permanent life insurance? Or are you looking for a little bit more flexibility like on a UL? Or do you really want to start chasing those better returns with no risk of loss and you want to go the index route? Whichever one that you do, go do your own research, go do your own legwork. This video here and many others are out there as a tool for you to make a great decision. But in order to choose to be a leader for life, we have to make sure that we better our financial position. And in order to better our financial position, death, disability, some catastrophic event that happens in your life, we never like to talk about it. It's not the fun part of the world, but every responsible leader has taken care of this if they get approved and if you can. Keep in mind, you may be in a position where you have to get approved for these policies. Your health, you have to get your health checked. So if you're able to get approved today, go get a policy today that's best for you and choose to be a leader for life. And look out for our next video that's coming out that's going to be about tax circles. And as we wrap up here, if you found any of this content to be useful for you and for your family, I want you to subscribe to our channel, Leader for Life. Right now we're on a financial series, but we go over leadership, politics, and we have other series that we cover. And so this might be something for somebody that's looking to make a decision right now on insurance needs. Also, if you have a comment that you'd like to share, maybe you have some advice, maybe you have something that you'd like us to produce, and we'll get back with our executive team and we'll talk about the content. Maybe we produce a video that's just for the specific need that you have. And whatever it is, you could contact us and we'll go ahead and we'll make sure that we provide a solution for you. And I hope that you choose to be a leader for life. Take care, guys. Bye-bye.